Okay, Bismillahirrahmanirrahim. Assalamualaikum. Now let's look at determining the price using absorption costing pricing and variable cost pricing. Okay, the first one is absorption cost pricing. So I will be very brief and short on this. Okay, you just need to know basic things about this. Okay, absorption costing. This one is consistent with GAAP. Okay, generally accepted accounting principles that include both variable and fixed manufacturing costs as your product cost. So if you want to calculate your cost, you will include both your variable and your fixed element. And then what about this one, only the manufacturing cost? What about the fixed selling and fixed admin cost, for example, that will be excluded from the product cost. Okay, so it's basically you compute the unit manufacturing cost, add a certain amount of markup, and then set your selling price. So this one is basically you calculate the manufacturing cost. That is, the manufacturing cost will include your variable manufacturing cost and your fixed manufacturing cost. So that's how you do for the absorption costing. Okay, you compute the unit manufacturing cost and then you add the certain amount of desired profit so that you will get the selling price. Okay, so this one, so that is for the absorption cost pricing. Okay, for the variable cost price, so for the absorption cost pricing, most companies that use cost plus pricing use either absorption cost or full cost as the basis. So absorption cost we see just now is just you take the total of your manufacturing cost, or full cost means you take all your fixed and variable costs. So reasons, information readily available, so it is more cost effective. Use of only variable cost may result in too low a price. Okay, suicidal price cutting, that means instead of just looking at the variable cost, you see the variable cost is too low, so you need to include your fixed cost as well. So most defensible base for justifying prices because you include your fixed and variable portion. If you are using the variable cost pricing, as the name implies, you just look at your variable cost. So your cost base consists of all variable costs associated with a product, but that will include your manufacturing as well as your non-manufacturing. That means your manufacturing, selling, admin, okay, all the distribution, so long as they are variable. So since fixed costs are not included in base, markup must provide for fixed costs and the target ROI. This one is useful if you are using a short run decision making, because we assume that in the long run, we assume in the short run your fixed cost is a constant. So your fixed cost is constant, and so if it is constant, then you only look at your variable cost. The variable cost means cost that varies. So you will take if you are using the variable cost pricing, you just take your variable cost, but your variable cost will include your manufacturing as well as your non-manufacturing variable cost, and then you compute a markup, then set your selling price. Okay, so that's basically how you compute it. And then why you use the variable cost pricing, that can avoid blurring effect of cost behavior on your operating income, and as it is also consistent with your CVP analysis. Remember, when you do the CVP analysis, you look at the sales minus your variable cost, that gives you your contribution. So contribution is an important concept in your CVP analysis. It also provides data for pricing special orders by showing incremental cost of accepting one or more orders. Why? Because if you remember, when we do incremental analysis, we look into the cost that varies, the differential cost. What about the fixed cost? So in the short run, we assume that the fixed cost is constant. So your fixed cost is irrelevant for your decision making in the short run. Okay. If it is constant, unless there were to be any changes in your fixed cost. And then it also avoids arbitrary allocation of common fixed costs to your individual product line. So the general idea, you have the variable cost pricing, and also you have the absorption cost pricing. So the absorption cost means they absorb the full cost. Or if you look at the variable cost, you only look at the variable portion of your cost. So basically, when you want to set the price, here, so you you take the, if you are taking the variable cost, you take the variable cost at a certain amount of profit or markup, then you will get your selling price. If you are taking that from the AC approach or the absorption costing approach, so you will take the full cost plus a certain amount of profit or markup, then you will get your selling price. Okay, another thing that you need to know is about the issues involved if you reside in different countries. So you can see if you have the divisions and then they are in the different countries, then there will be a tax effect. Okay, you just need to know there will be a tax effect uh, for the transfer that takes place between different countries. So you can have a go at this one. So you just need to know a little bit about this. What is the tax rate? And then the tax rate will be different between these countries. And then tax effect of the internal transfer. Okay, so hopefully you have a better understanding on this topic. So that's all the things that you need to know for this topic. So with that, I thank you.